Passive Pockets is presented by Equity Trust. If you're a fan of Passive Pockets, chances are you know our guest today, Scott Trench, longtime contributor, podcast host, and former CEO of BiggerPockets. Today's conversation isn't just about real estate. It's about evolving your mindset around financial freedom. Welcome to Passive Pockets, the passive real estate investing show brought to you by Equity Trust. I'm Jim Pfeifer, and today I'm sitting down with Scott Trench to unpack the philosophies behind FIRE, flow, and full ownership. From frugality to flexibility, from LPs to direct control, Scott shares what he's learned by living every side of the financial independence journey. Let's get into it. All right, I'm really excited today to have you here, Scott. Really appreciate you being on the show.
Yeah, thanks for having me back, Jim. Look forward to a really violent fight over good conversation.
Yeah, either one. I'll take either. The first thing, before we start fighting, I'd love to, and I know most of our audience is familiar with you and knows some of your story, but I'd like just to back it up and talk about how did you first get into real estate and how did that lead you to BiggerPockets? So you just give us a quick overview of that. That'd be awesome.
I wanted to retire early in my career, and I discovered back in 2013 two resources that helped me do that. There's many that influenced me along the way, but the two most memorable ones were Mr. Money Mustache and BiggerPockets. And I was going to frugal my way to financial independence while investing in real estate. And real estate was, at that time, less attractive to me as the answer to how to build wealth and more of an obvious first step. The house hack specifically was a combination of frugality. Why would I spend all this time packing lunches and, clipping coupons, all that kind of stuff when my biggest expense was obviously my housing. How could I get that to zero? So that was the first concept there. I bought my first place in 2014 and around the same time joined BiggerPockets as an employee because I had the good fortune of meeting the founder when it was still a very, very small company, and I was very excited about what was going on there. So that kind of got me started on this journey, and then I just house hacked a few more times off and on for the next 10 years and finally done house hacking. And that got me my portfolio snowballing and my savings rate beginning to accelerate.
So you mentioned in here about being frugal, and that brings me to the FIRE philosophy, right? It's financial independence, retire early. And you've done that, obviously. And you have a podcast about it also, right? BP Money. For those who aren't familiar, can you just define FIRE and explain what drew you to it?
Financial independence, retire early, is the concept of building a portfolio that produces more income than the desired lifestyle. And then actually using that portfolio to leave wage-paying work or build a life that you enjoy. So I think for most folks, the pursuit of FIRE is with the intention of ultimately leaving wage-paying work, although that does not always play out that way. Many people begin to enjoy their job. There seems to be an effect of as you go from zero to $2.5 million, which is the midpoint, at which BiggerPockets Money listeners believe that ask BiggerPockets Money listeners, what's your FIRE number? Half of them say below 2.5 million, the other half say 2.5 million or above. So at that level, people typically don't continue to work jobs that they hate unless the golden handcuffs are so huge that they're going to stick around for one more year. So at some point on that journey from zero or the first 100 grand or so in net worth to this FIRE number, people begin to really reap the benefits of flexibility that financial independence brings into their lives.
You said that in an interesting way because I've always thought of FIRE as, really penny pinching. And the way you said it is almost how at Passive Pockets, a lot of us look at financial freedom is just, more coming in than going out, right? So, I also, in listening to your podcast, I think it was an episode where you shared an example about how you kind of skipped a fantasy football league with your buddies when you were younger, and it was like $100 or something because you were really into the FIRE discipline, and you might have had some regrets about that. So has that experience shaped your view of FIRE and the way you explain it, perhaps?
Yeah, I think that there's the social aspect. There's things that are more important than FIRE in life, friendships and social events and those types of things. But I would say that, that's one of the rare mistakes on my journey, I believe, that particular decision. I think that for the most part, I did go on the occasional trip had plenty of fun on the weekends, and otherwise managed to enjoy my 20s while accumulating wealth. And the reason for that was because I made great decisions on the housing front with house hacks, with my vehicle, which was a Toyota Corolla, and with my everyday food decisions. I shopped and made the same meals over and over and over again and packed lunch for a good chunk of those 20s. And that kept my expenses low. And I think when you think about FIRE and frugality, the reason why that hurdle is so hard for people to get over is because it is the first step on the FIRE journey, and it is the most important early in life, especially when you're earning around a median income. Most people, when they begin to think about the concept of FIRE, are starting that journey with a medium or maybe middle or upper middle class income, and they're maxed out. This is the best job that they could get. That is not, relative to the amount of hours they're willing to work. Some people are not willing to work 80 to 100 hours a week, but at 40, 50 hours a week, this is the maximum amount of pay that this person could get in the area that they choose to live within a few percentage points. And there's not room for optimization on the income front. There are no dollars to invest. There is no skill set or advantage or entrepreneurial itch that allows them to start a business. And if that's you, which is a great, perhaps majority of people who begin this journey, you must adopt some version of extreme frugality in the beginning, or you just need to let time pass, years and years pass. And so I think that's where the rub is very few people who FIRE will not have gone through that step for a handful of years, by definition, early in life. The outliers will, of course, be high income people who earn so much and just didn't move the goalposts, or otherwise, come into assets some way, business owners, inheritance, whatever. There are plenty of ways to get around it. But for so many, you have to go through that. And I think that that's the mentality, is you go through that for a few years. I'm 34 now. I live in a nice house. It's paid off, and I'm able to spend a very good amount every month. By no means would someone call me frugal here in 2025, but I was in order to get here so that my asset base could do that. And I think that's a piece of the puzzle that needs to be reflected, and maybe harder to empathize with if you are a PassivePockets accredited investor, by definition, a multimillionaire or earning a high amount of dollars.
Right, and that's fascinating to me, because when I hear FIRE, I think of spend less, save more, maybe hopefully you'll have enough to enjoy life later. And, how do you know when you get to later? And it seems like more of a scarcity mindset than an abundance mindset. But hearing you describe it, it's really more of a, hey, when you're young and you don't maximize, or you don't have that top earning potential, you got to make some choices, right? And a choice is maybe minimize in some areas so you can maximize your future potential. Is that kind of how it looks to you? I think that's how you explained it, and I think I had it wrong a little bit.
I think it means a lot of things to a lot of people, and that's why there's all these different jargony terms out there. There's barista-fi, which means, hey, I have enough wealth where I can work a barista job, and my assets will grow to fund my traditional retirement, and I can begin traveling the world right now. There's lean-fi, which I think many people would say is retiring early with less than $1 million in assets. And on $1 million portfolio, that means typically people in the FIRE community plan to spend less than $40,000 per year, which is not something I don't think I would enjoy as much today here at 34 with a family. There's the midpoint of the FIRE community, which I think is more in that fairway around between that $1 and $2.5 million range. Again, that's the midpoint for BiggerPockets money listeners. BiggerPockets money listeners may want more than the average FIRE community member. I don't know. There's chubby FIRE, which is kind of in that 2.5 to 5 million, which is kind of like, I'm going to live that upper middle class lifestyle. I'm going to spend, let's call it 100 to 175 a year, somewhere in that ballpark. And then fat FIRE begins, depending on who you ask, at $5 or $10 million in net worth. And it's kind of like, you could just do whatever you want. That's typically filled with entrepreneurs or high-powered executives or other folks who have otherwise made, millions and millions of dollars. So it means something different to everybody in this space. But I think that the binding concept is how does that portfolio safely generate more than I need to live off of, so I can really just enjoy my life and not have to think about work as a primary income stream.
Okay, so I'm trying to put this into context, because I was looking into FIRE, like trying to understand it, and I came up with of course the help of my friend ChatGPT, something I call flow. FLOW, which is financial liberty and ownership of wealth streams. And ChatGPT worked really hard to kind of find the letters there that worked into a word. But it's to me, it's the pursuit of financial freedom through acquiring cash flow from multiple income streams rather than chasing accumulation where then you take the 4% out. And you kind of touched on that. So it seems to me that maybe FIRE in the traditional sense, the frugal part of FIRE would be useful in the early phase of life, where flow is where you're accumulating wealth in the later life. And before you comment, because I'd love to hear what you think about that, I guess my analogy or how I look at it is if you have two people, right, that are retiring and they both have $1 million, just for easy math, right? The one person who's just going to take out 4%, and maybe they have their money in the stock market, or maybe they're FIRE or whatever, it doesn't really matter. But if they're in the stock market, they're taking out the 4%, so it's 40 grand. They're paying taxes, so let's say it's 25%. So you end up with 30 grand. And I would say that's probably the most you're ever going to get, right? Because you have to keep that $1 million there, because if the market goes down, you're going to have to take money out, and it's never really going to go that much up. So you're stuck at 30 grand, and that's probably the most you're going to get. Where if I look at someone who's, ownership of wealth streams, and they have $1 million, and maybe they're investing in real estate syndications like I do, it's pretty not easy, but likely that you could get, let's say, 7% return, right? But that's from the asset. It's cash flow. So, and you're not paying tax on it if you do it right. So you're getting 70 grand, right? And that's the lowest you'll ever be, because we're not counting the appreciation of the assets that will come because you're not taking money out of the bucket. Now, I just said a whole lot. So I'd like your thoughts on kind of how you feel about what I just explained. And am I getting FIRE and flow mixed up? Does that make any sense?
Well, I think first of all, I just want to say that thank goodness the world of FIRE, Lean Fi, Barista Fi, needed another acronym. So thank you for your addition to the.
Of course, happy to help. Happy to help.
I'm going to react in several pieces to what you just said here. Let's talk distributions, or the concept of decumulation from a portfolio, right? Which is what you're trying to wrap your head around here. So I've got $1 million that's in a 60-40 stock bond portfolio. And the portfolio only generates 2.5% in yield and income between the dividends on a 1.6% dividend yield on a standard S&P 500 index fund, low fee index fund, and a small amount from the bonds, which, by the way, very few FIRE adherents actually invest in bonds in any capacity because the yields are so low. So they're typically entirely in stock market funds. That's another issue. So this person, in order to withdraw the $40,000 pre-tax, will need to sell a portion of the stock portfolio. And this is what you're trying to wrap your head around. And first, I want to point out that essentially no one does this. This is the theory that governs FIRE. And I have been pretty obsessed and annoying people in the FIRE community recently because I've been pointing out that this just does not happen. You will not meet this person, or you'll meet them incredibly rarely, that actually sells off the principal balance of a stock market portfolio, for example, and then uses that to fund consumption in their lifestyle. So it's very rare. But that does not mean it's not theoretically correct. That the cash flow from a stock portfolio, that yield on a S&P 500 index fund is 1.6% or whatever from a dividend perspective. But that is not the cash flow that is being generated by the companies in the S&P 500. That cash flow is double that number at least. And that cash is being used to pay down debt for those companies, or buy back shares. Or acquire companies, or being put to other uses. So that is your cash as the owner of those companies, and it is more efficient for a number of reasons, including tax advantages, for those companies to use that cash to, for example, repurchase shares. So when you sell off these stocks, you are not diluting your principal position in the way that you think you are. You're spending at least some of the cash that is being put back into those companies. So that's the first, I wanted to touch on that there. The second component is this 4% decumulation concept is grounded in research from William Bengen in the Trinity study, where he went back and looked through a number. He's since updated it, actually. You can do a little bit higher number depending on how you move your portfolio. So I think his new number is 4.7%, which is great news. You can accumulate a little less and never run out of money over 30 years. This takes into account the worst environments for retirees to decumulate, to withdraw from their portfolio and spend that in history that we have data for. In most situations, someone who is withdrawing at 4% from a portfolio of 60-40 stock bonds or 70-30 stock bonds will end up with millions more, $1 million, starting with $1 million by the time that they retire. They'll end up with much more principal balance, and that all adjusts for inflation, by the way, over that 30-year period. So it's a very, very safe rule of thumb. When you think about the syndication world, let's use a debt fund that's generating a 7% interest yield, right? Well, we can talk about debt funds. I will talk about debt funds to preview this, but the debt fund is backing hard money loans, which are short-term fix and flip loans. It's usually geographically concentrated. That debt fund is going to be typically levered at 30 to 50% with, a bank loan against that. There's going to be one guy who's really important to that debt fund. And assuming that they're great and there are no character issues, or that person doesn't, get lazy or go on vacation for too long or try to hand it over to somebody else, that person can get hit by a bus, like he gets sick. So there are risks to this debt fund, and it is not a straight 7% yield that you're going to get in perpetuity. There is a worst case scenario that we must account for if we want to compare it to the 4% rule, which takes into account the worst case scenario to go against that risk of that withdrawal. So I agree, by the way, that some money should be in syndications for many people who are interested in this subject, or real estate investors, and I will do this personally. I just those would be my two major responses to your argument. Last, but then I'll let you go. I'd love to touch on taxes. Taxes are a non-factor in the example that we're using, and probably up to $3-4 million, because the first, I think $85,000, for example, in capital gains or dividend income is tax-free for someone that we're talking about here. The next, I think $600,000 is going to be taxed at 15%. And then after that, the tax rate will rise to 20%. So depending on your state, you could be paying as little as 0 or 15% for up to that first $600,000 in liquidity that you'd want to generate as an early retiree. The tax code that is under today's current tax code. It could be different in the future, but using today's example, there is no tax consequence for that, and there would be a minimal tax consequence, of course, for your counterfactual. You get receiving the 7% simple interest yield. So how's that for utter nerdery in response to your question?
No, that was fantastic. I guess my pushback on that would be, and maybe I should have set it up differently, is whether it's $1 million or $10 million, right? The idea for me is that one strategy is you're in the stock market, which to me, and it's just my feeling, is more speculative than it is investing. Because, the example I always use is if Apple has their best year ever and the stock market tanks, Apple's going down too, right? Most likely. And most people hope, that listen to this podcast are hoping for having more than $1 million, so those tax implications would be different. And what I'm looking at is the concept of, are you drawing down capital through this 4% or 4.7% rule on assets that are more likely to be taxed and than the other way? Whereas if you're in real estate or syndications, doesn't really matter for the other example, where you're getting this cash flow that is from an asset that is sent directly to you, not to the company, but to you, and it's not really taxed, and then appreciation is just the upside. So I think conceptually for me, I can't see a world where I'm, just taking 4% out of my portfolio, because although the 7% I'm talking about is bumpy and not consistent, it might be 12% one year and 3% the next, and that doesn't add up to 7. But that's my point, is I can manage those. I think it's just conceptually that I'm looking at it, and I'd like to hear what you have to say to kind of just, rather than digging into the numbers, which what you said all makes sense. How do you feel about as concepts?
So I just spent some time explaining the decumulation concept with the 4% rule and why this theory and mathematics behind it all makes sense. That said, I'm going to annoy everybody here and say I can't follow it. I can't do it. I cannot, at 34, bring myself to sell equity positions to fund consumption in my lifestyle. And I'm not alone. BlackRock did this study. On average, retirees hold on to 80% of their pre-tax retirement savings, which means that most retirees, the vast majority, these are traditional retirees. Forget the folks that are under that age bracket, like us, right? This 80% of truly retired folks do not decumulate. They do not sell equity positions, which means that they live primarily off of the income generated by their portfolios. And this is a major mental and psychological barrier. It is absolutely a reality that the majority of people watching this or listening to this or pursuing FIRE will face. They might think their FIRE with 4% rule, but they won't spend it. I am still looking for the first person ever who I will meet who actually withdraws as an early retiree from a 60-40 stock bond portfolio using that 4% rule of thumb and does not have some ace in the hole, no side job, no free healthcare benefits, no military pension. It's amazing how people say, I do that, but I actually don't have to do it because I live on my pension. Or I have a 3-year cash cushion, or I get my healthcare funded. Or the best one is, oh yeah, I'm FIRE, I'm everything's set. But I actually haven't had to withdraw from my portfolio because my wife still works, wife-fi, and provides benefits, or vice versa, right? The wife-fi just goes better than husband-fi. It just has more of a ring to it. That's a major problem. And so that's the reason why my portfolio does not reflect the 60-40 stock bond mix and is primarily in real estate. There's something different about the cash flow from a rental property, a conservative approximation of that cash flow. But I feel fine, totally fine depositing that in my checking account and spending it. And I just don't feel the same way about the stock portfolio and selling off chunks of it.
For me, as an ex-financial advisor, a lot of it comes down to, having a plan, putting it in place, and then when you get to the point where you've accomplished the plan, or you're at the stage where you're supposed to do what the financial advisor said, take the 4% out, or the FIRE person or whatever, that then you have built in, or you have other options so you don't have to do that. So it's kind of like it's the cushion. I think it's important to have a philosophy and an understanding. And for me, and it might not be FIRE, it might be something different. What I'm trying to steer away from is I would rather accumulate cash flows than accumulate assets. And because cash flow is what allows me to live. And as you said, assets are something I'd have to sell off. And then there's all kinds of implications from that. So for me, as I'm trying to think of where I'm going, it's important that people have cash flows and wealth streams, or whatever you want to call it, rather than just, hey, I have a bunch of assets, because assets don't do anything for you unless they can, produce cash flow.
I completely agree. That's why my portfolio is mostly in real estate, producing cash flow that I feel comfortable spending.
Okay, well, I am tired of agreeing with you, Scott, so I'm going to move on to where you were on LinkedIn recently, and you posted that syndications are terrible and everyone should own real estate. That is not what you said exactly, but you made clear that you're still going to invest in syndications, but you prefer control of your own assets. And I guess I want to kind of dig into that, because I feel the opposite way. And I feel like the strategy that you have is something that might only work if you have a competitive advantage, right? Like when I was an active investor, I was terrible at it. I couldn't swing a hammer. I didn't know my market well. And so syndication solved that for me. But you are arguing the opposite point, that owning your own real estate because you have control on other things is a better way to go. So tell me why I'm wrong and you're right.
Let's frame it for my situation specifically here, right? If you want to buy real estate, whether it's a syndication or your direct investments like what I do, there's a price that you have to pay. You're paying that price right now if you're a syndication investor, because you're listening to this podcast. The price is not in terms of dollars, it's time. You should spend 100, 250, somewhere in that range, number of hours self-educating and building mental models before you begin committing money to a high-risk, high-leverage asset class that has a large number of mental models associated with it, like real estate investing. I have paid that price over the last 10 years as I've lived in my properties, ran BiggerPockets, consumed hundreds or if not 1,000 podcasts, recorded 700 podcasts, interviewing folks. And I have those mental models. I will make mistakes. I will not be a perfect investor. I may lose money in many situations, but that is a competitive advantage that I have built up, and many investors who have learned about these concepts through BiggerPockets have that same advantage there. And by the way, if you don't pay that price up front, you'll pay it on the back end as you spend several hundred hours with your fellow LPs trying to figure out how to get your money back from the GP, or figuring out how to deal with a terrible tenant situation that you got yourself into as a direct real estate investor, or a terrible contractor situation that you got yourself into, or a property manager situation when they steal all of your money, rent rolls for 2 months and all your security deposits, which is what happened to me. And so there are real risks with both of these approaches. When I think about real estate and what I'm trying to do here, it's FIRE, right? And real estate at its core, to me, is a hedge against inflation. A rental property that's worth $500,000 today is going to be worth $500,000 in 30 years. adjusted for inflation, give or take a few percentage points. The income stream of, let's call it 30, 40 grand is going to be 30, 40 grand in 30 years, plus or minus a few percentage points, give or take inflation. That's it. If I use leverage and I buy a $1.2 million property instead of a $300,000 property, I'm going to have in 30 years a $1.2 million asset and the income stream at that rate. And so when I think about what I'm trying to do for my portfolio to generate this cash flow, I'm going to have a paid off property. I can choose when to buy or sell. And if I run it correctly and do the work, this is not a full-time job. People say, oh, it's not passive. It's not passive. It's not totally passive, but it's also not a full-time job. I am not spending 10 hours a month per property on these things. I might spend 1 hour per month per property at most over the course of a year on these things. And that generates this income that I'm very comfortable spending, and I feel great about it. Again, I cannot bring myself to decumulate stocks. The volatility that happens in the stock market, a sequence of returns risk, and the way my brain works, I spend a minority of my cash flows. So that's what I'm looking for in my real estate investments. In a syndication investment, I have a little bit more trouble in many cases creating that same outcome that I'm going for in my rental properties. So for example, if I just want income, I'd have to find a totally unlevered or very, very lightly levered syndication fund. Or if I want cash flow, I'll have to go into these debt funds. And I will do both syndication investments and debt funds as part of my portfolio. In fact, I am going to do that for the first time in my life. I'm actually going to be able to set up an SDIRA as some things have changed and I have all different sources of income that will allow me to do that. And that is the wonderful tool, in my opinion, for investing in debt funds. Right? It doesn't make sense for me to generate simple interest in a year where I'm going to have high ordinary income, because that is very tax inefficient. But in an IRA, it's great. It's a pretty stable compounding return there. And I have a whole strategy around how I'm going to think about debt fund investing inside of that. The other use case for syndications for me is I'm kind of like a real estate nerd, and I'm going to time the market, as bad as taboo as that it is in a lot of ways. I think this next 6 to 12 month period is going to be a pretty good down part of the cycle here. And I do not have the means or capacity to purchase a $20 million apartment complex that used to be worth $35 million and guarantee the debt personally and buy it and reposition it and hold it for the next several years. That's where the syndication comes in my view, because I can put my money into a deal right now where someone else is levering that up. And that is a real shot at much better returns than what I can get. Well, certainly than what I'll get with my paid off, boring, old school, old fashioned rental property portfolio. That's, for that pays the bills on a regular basis. So that's kind of my thought process in terms of rentals versus syndications. And that's where I was arguing, for my purposes, I feel I'd be crazy to put 80% of my net worth in syndications because of the high fees and the high leverage that typically come with them. I'm sure some other people would feel differently, but that's how it is for me. And I will put 10, 15% in syndications, but in a more aggressive approach or for different objectives.
Yeah, there's a lot to not push back on, but discuss here. And part of it is, when I had active real estate, I was not spending 1 hour per month, right? I was spending, hours and hours on my active real estate because I wasn't very good at it, right? So I think that part of it for me is, I'm not saying you shouldn't be an active real estate investor and everyone should be passive. What I've found is I should be passive because I was not good at active. And so everybody kind of has to figure out their mix and where they are in that. But one thing I do want to ask you about is, Chris Lopez is doing this new program, Active to Passive, right? To talk to active landlords who might want to reposition their portfolios. And he said something that is so basic, but something that I hadn't really thought of. And I'm going to use a terrible example, but let's say you buy a property for, I don't know, 100 grand and you have 50% leverage. So you put 50 grand in, it's worth 100 grand. And then, X number of years later, it's worth $1 million. And you've only put 50 grand into this thing, and the rest is just because it depreciated or whatever. So now when you look at the way I looked at it is, if I was, let's say it's now cash flowing at 50 grand a year, I would look at it and say, I got 100% return, right? Because I invested 50 grand and I'm making 50 grand every year from it. That's fantastic. The way Chris is looking at it is, wait a second, you have I'm rounding, $1 million in equity on that, and you're only earning 50 grand. Now, if you go and take that $1 million of equity out and put it into something else, anything else, you're going to be able to earn more than that 50 grand, right? Because is that how you look at your properties? Because if you look at it return on equity rather than, I think, return on invested capital, then you come up with two completely different answers to the question. And the opportunity cost is if you're looking at return on investment, then you're losing out. Right?
I think it just depends on your goals, right? There's no world where if I was 23 and starting over, I'd be buying a rental property and then paying it off. And that's my strategy, right? But like, I'm not 23 years old anymore. I'm a financially independent guy in his 30s that got lucky and had a wonderful career opportunity and joined BiggerPockets as an early employee. And my goal is to have a portfolio that I am pretty darn sure is going to produce the income that I want to spend. And so no way. My equity value in this portfolio is going to accrete at like 3.5% per year. And my income stream is going to grow around the same level. Maybe I'll get a little better if rents rise precipitously, which I think is likely over the next 3 years with the lack of supply coming online here in Denver. But like, I'm not going to take this portfolio and I'm not going to earn 10% on the principal every year, much less 15, 17%. And that's not my goal with this portion of my portfolio. This portion of my portfolio is generate way more income than Scott Trench's family needs to live. And then other parts of the portfolio, Chris is right. I would need to get more of a return to justify it. And that's absolutely, like, I'm not going to invest in a syndication that's promising me 7% returns. No way. I can get that plus some on a rental property that's adjusted for inflation, where I completely control the timing of the purchase and exit with property management all day long here. So I'm not going to do that with a syndication investment, which is just more risk for the same return, even though I am going to do more work on my end for it. But if I absolutely will chase the higher returns with syndications with a portion of my portfolio too.
So how do you diversify then? Because when I look at active real estate, right, and I might not have your portfolio all figured out, but if you're mostly in Denver and you're mostly in 1 to 4 unit housing, then in syndications, I'm in all the markets, right? I'm everywhere. I have different operators. So you also have single operator risk, which I don't have. You have a market risk in one market, which I don't have. You're in one asset class. I'm in all of them because I chase the shiny object. So I'm in every asset class, which I'm not saying is a good thing, but you're not diversifying by that. Maybe you're diversifying by debt and some of the other ways that we diversify. But the three main ways of diversification as a active real estate investor, you don't have that and you can't get it. So do you get that? Is that part of the reason you invest in syndications, or do you just have confidence that Denver, Scott Trench, and housing are strong enough that you don't need to diversify?
So I would say a couple of answers to that. One is by the end of Q1 next year, half of my wealth, around that 55, 60% mark, will be in my primary residence and or rental property equity here in the Denver metro area. The remaining 40% will be in syndications and S&P 500 index funds. And so implicit in that is absolutely the geographic concentration and risk profile that you're talking about of the Denver metro area. And I agree that's a real concern with my portfolio. I believe the upside, however, is much greater than that for a couple of reasons. One, I'm happy to bet on Denver long term. I think this is an awesome city. I think it's got a lot going for it. I think that there's always going to be more people who want to move here than the ability for this city to construct new housing. And that's not because we don't lack land, but because we lack water rights. And it's hard to construct and get access to the reservoirs that would be needed to sustain large-scale new investments in housing. It's beautiful out here. People move here because they want to, and the job market is good. It is not the best job market in the country. It's not Austin, Texas, for example, in terms of new stuff, but it's a pretty good market. So for those reasons, I'm happy to bet on Denver long term. In the event that something changes where Denver is no longer a desirable place to live, then that will disrupt much more than just my investment portfolio. It'll disrupt my way of life, the lifestyle that I am intentionally building towards here, because I want to live here in this specific location within the metro of Denver, and I want to live the lifestyle that I live currently, looking at the mountains and going on my mountain bike out there on the trails. So that's what I'm looking for. That is absolutely a bet I'm comfortable with, and absolutely you should not repeat that bet in your metro if you're not reasonably comfortable with what's implied in that. Then the other side of that is what advantages do I have right? I should be able to do particularly well here in Denver for a number of reasons. One, I've studied real estate a lot. I'm not the most masterful real estate investor, but I've put a lot more time into this than most people that are buying the type of property that I have. I lived in half my portfolio, and I've lived in the areas that I'm buying my properties. I see them changing over the years. All my properties are of the same type, the same, like typically they're all 1950s builds. They've all got the same types of finishes, same types of foundations, same types of roofs, all those kinds of things. I can drive to these properties. I can fix up the problems myself. I can manage them if I need to and fire my property manager if push comes to shove to save costs, and otherwise feel comfortable self-operating on a lot of these. And those are real advantages. When a deal comes on the market, I can look at the MLS and be like, that's a pretty good one. I think that's, I don't know if that's, maybe there's be a better deal this year, but that might be the winner for me in the entire Denver metro area. In terms of asking price on the MLS currently. Maybe there's some off-market ones that'll go through that I won't see, but it's pretty good. That's how I felt about my last two that I've purchased. And so those are real advantages too that reduce risk or increase returns. And then last, I'll also call out that there's opportunity here as well. Let's say that the market crashes, right? And there's a big crash in the stock market, for example, and there's a recession, a deep recession that comes through. Rents are impacted, that hurts things, but I don't have any leverage on most of this portfolio at this point. So what will I do? I'll go take a loan out on these properties, which is not an option that I would have if I was in a syndication. And I don't know what I'll do at that point in time, but I will be able to use that somehow productively. So I retain the option to go big in the event that their opportunity does strike. So those are my counters to your astute observation that yes, I am taking risks with geographic concentration in one asset class here in Denver, but I gain something for that risk too.
Yeah, and that makes sense. But can you have the same conversation that you just did, but not with an early employee at BiggerPockets who had all kinds of opportunities to experience real estate, someone who doesn't get the opportunity to interview anybody they want on a podcast, who doesn't live in an awesome place like Denver, like just somebody else, and how do they make the decision? Am I, okay, so now we've all decided real estate is where it's at, right? You and I agree on that. So now this hypothetical person who doesn't live in a great place and doesn't have maybe all of these skills, can't swing a hammer, doesn't know a market, how do you make the decision between active, passive? And when I'm saying active, I'm meaning owning your own, having operational control, and passive, I mean syndication. So how does somebody else who's not in the positions we are in make that decision?
Well, I think it's very easy. If you can't swing a hammer, would feel totally uncomfortable talking to a tenant about a lease renewal, are not comfortable driving past the types of rental properties that you can afford in your local area, you shouldn't invest in active real estate. My story is not the BiggerPockets part is unrepeatable, but I talk about, I don't know what the advantage is I actually get in the market from that. I don't know if I've ever gotten a deal because of that. I certainly got ripped off by a property manager. That didn't stop him from stealing my money.
It's more the knowledge though, right? Just being in it.
But there are plenty of investors in the local market that have been doing this for 20, 30 years that have much more knowledge than me. So it is a journey you'll go on to get this, but you'll have that same journey in the syndication space.
True.
So, and if you don't, you're either getting lucky or you're going to have that journey on the back end as you're dealing with somebody who's departing with your money and talking about their beach home while your syndication is giving a capital call. There's no free lunch in investing. But I would say this, if you are an accredited investor, already an accredited investor, a very high income earner, and you don't have the capacity or willingness to swing a hammer or to drive past properties or whatever, you should be a passive investor, not an active investor. And if you are young, hungry, getting started in life, and you should live in your own properties and build up that toolkit. And I think I'd be foolish to put most of my money in syndications at this point. I think you'd be foolish to put most of your money in actively managed properties at this point. If you'd started in your 20s buying duplexes and manage them and invest in the systems, I think you'd feel very differently.
Yeah, and I wish I had found real estate earlier in any shape or form. Now, in that LinkedIn post, you said that most or all, I don't remember which, of your active real estate is doing fine, and most or all of your syndications are underwater. And my question is, well, why is that?
Because I bought my syndications. I rolled into I either invested in or rolled into new syndications in 2021.
So that's why. right? Just bad timing.
I did buy a property in 2021. It's doing fine. So I don't know what I get if I sold it for it right now, but I probably would get most of my money back, but not all after transaction fees. So
When I was an active investor, all of my investments, they never cash flowed like they were supposed to. Not one of them. But, I was super fortunate, lucky, in fact, with the timing when I bought them when everything was low, and then I found syndication and sold them after everything had just gone up, up, up. But I realized that I'm just a bad asset manager, right? It's not for me, which is why I'm a syndication investor. So for you, how are you thinking about moving forward? Because you've had some bad experiences with syndications, and a lot of that is because of the timing of when you invested. So what are you doing to make sure, because you said you're going to put, 15%-ish into syndications moving forward. So how are you going about learning, educating yourself, or just becoming, a syndication investor for that bucket of cash that you're going to use for that? How are you going to make sure, other than market timing, that doesn't happen to you again?
I think part of the answer is timing. And I know that that's a taboo topic for a lot of investors here, but I think, look, if you're going to buy an asset and hold on to it for 30 years, timing doesn't matter that much, right? It doesn't matter. And the price you pay doesn't matter that much. So like my first duplex, I bought it for $240. Thing's probably worth $550 today. Does it matter that I got it for $240 instead of $220 or $260, which would have been an all-consuming decision at that point in time? It doesn't matter, because I held it for 10 years. I'm going to hold it for another 20 years. The graph, the parabola of my return on equity is going to be dictated by one thing: long-term market appreciation. 80% of my return will be there. 15% will be how I manage the property, and 5% will be that initial purchase price when I go to sell it, and at some point, if I hold on to it for 30 years. Right. With syndications, that is not the same case, because these are timed investments for the most part. Broadly speaking, a syndication investment is a 3 to 5 year investment thesis. Sometimes there'll be 7, but you don't find a lot of 20 plus year holds. You'll find syndicators who conservatively underwrite as if they're going to hold for 20 years, but that's not your purpose with it. And it shouldn't be, because you're handing over your money to somebody who's going to make a decision for a long period of time. And the other part of that is, because you're handing your money over to somebody else who's making the decision-making rights, it's a illiquid investment. You cannot get your money out of it. We occasionally will see somebody attempt to sell private shares. Most of the time, they don't even allow that in the documents for these deals. And good luck attempting to find a real buyer. So these are highly illiquid investments where you surrender control. So it is a timing play. You can avoid the timing risk by making a cascading series of investments, trying to recreate dollar cost averaging over long time horizons, but you'll always be subject to timing. So that's my first answer, is get the timing right. And so I have spent a large amount of time thinking about timing. I think real estate timing is at least a little easier than stock market timing, which I think is almost impossible for the vast majority. And my thesis around timing is supply is the major factor. Interest rates are a wild card, and demand, how fast your city is going to grow, are very hard to compute, and lots of wild card things can come in and change things up. But you know very clearly how many units your city is going to construct over the next 2 to 3 years. And if you run rate demand alongside that, you at least won't get caught with your pants down, I don't think, in the worst part of a real estate cycle. Sure, if there's a depression or recession or some other macro that really crushes everybody, you're going to lose. But at least you can get that part of it right. And so that's going to be one of my core theses going forward. And so what I'm looking to look for is and surprise, surprise, Denver is going to come up on this list, but where are the markets that are going to construct the least amount of new inventory relative to both existing housing stock and a reasonable approximation for demand, right? Denver is going to grow at 1% a year for the next 10 years. People will argue that. I don't really care. Like, well, let's come back and watch Denver have grown between 1 and 1.25% every year for the next 10 years. Maybe 1 year is down, maybe 1 year is up. I'm not going to be wrong fundamentally on that. And if I'm even close to that, and they only build 5,000 units on, what is that, 40,000 people coming in every year, rents are going to go up. Maybe cap rates expand, like I still lose on the investment, but I shouldn't get crushed in a syndication investment with that thesis. I feel the same way about markets like Dallas. I think Phoenix will be slightly delayed because they have so much still hitting in the rest of this year, but that will be the same story. Following that, you're going to see rents grow pretty dramatically. You're seeing that already happen in New York. I saw something like New York City has added 15%. Rents have grown 15% year over year in Manhattan, or something crazy. Don't quote me on that. The internet these days can have those things, but I'll go verify that. But I think that supply factor is a major impetus to the thesis behind multifamily investing and something that I'm going to it's easy to become an expert in. So that's going to guide one thing. The second is credit funds. I've been thinking about these for years. And when I say credit fund, I mean a hard money lending business. So someone lending to fix and flippers or new construction, bridge financing. And this has been around for a long time, but it's become hot lately, which terrifies me, right? When short-term rentals get hot, oof, something bad's around the corner. If I'm making up midterm rentals, but midterm rentals are hot. Oof, how's that going to go? Okay, this one's the new one. This one's the new one. So credit funds are kind of that new one right now. Again, the business has been around for a while, and for these guys to lose, some very bad things have to happen, but they can lose. But I do like the idea of that very high level of simple interest and the ability to kind of look for, hey, I've done a lot of study on this. Can I find these debt funds that are responsibly levered, that lend to reasonable borrowers, seem to know what they're doing, and spread my risk across 4 or 5 operators geographically to get that income, that simple interest, in ways that'll make me feel more comfortable with a portion of my portfolio, especially where it's tax advantaged. So that's my thesis in a nutshell. I think I'll deploy 5 to 15% of my wealth in bets of those types and call them bets. I put a lot of thought into it. So if I lose, I can live with it.
That's clear. And I think the overall message that I'm getting from this is every person has a different strategy because every person has different experiences and strengths and places where they come from and where they're going and what they desire, right? So you're not swinging for the fences with every single dollar and trying to maximize return of every single dollar because you're in a place where you're comfortable and good to go. And kind of I'm the same way. I'm more of a chase the shiny object because it's fun and cool. And I win and lose both on that. And I need to kind of dial that down. So I think each of us is in the right place for our skill set. And that's the bottom line. Every person listening has to find out where they fit in for their skill sets and their experience. Would you agree with that?
100%. And would you say then that folks also should allocate about 10 to 40% of their wealth to Bitcoin, like this one social media post going around is saying?
I would say absolutely yes if it's going to go to $1 million, but I can't say it is or not. But I will say this is another place where we differ, and we can argue about this one on the next podcast, is I do like to speculate a little bit. So I do have some money in Bitcoin. I don't know if I believe in it or not, but it has consistently gone up. So I'm happy so far with my Bitcoin investment until I'm not.
I figure, if Bitcoin goes up enough, then these rental properties I invest in will be collecting their rent in Satoshis.
And that solves all the problems, right? Because you'll still be benefiting from Bitcoin, even though you don't invest in it.
At that point, I'll own crypto.
That's fantastic.
But for now, the rent is due in dollars.
Exactly. Well, Scott, this has been fascinating. Thank you so much. I think we came to agreement on real estate is good, and you just got to figure out where you fit in it and where you can do it best. So thank you very much for being on the show. We really appreciate you.
There's certainly not enough blood in this particular fight. Thanks, Jim.
We'll do it next time. We'll get into a bigger fight next time. All right. Thank you. From fire to flow and active real estate to passive, thank you to Scott Trench for giving us an honest look at how real estate strategies and mindsets evolve over time. There is no one-size-fits-all solution in real estate. The key is knowing your goals, your skills, and your stage of life and building a strategy that works for you. If this episode resonated with you, be sure to like, subscribe, and join our LP community at PassivePockets.com and enjoy our 7-day free trial. Thanks for tuning in, and as always, happy investing.